There's a signal flashing in the silver market right now that has appeared before every major financial catastrophe of the past century. A signal so precise, so historically accurate, that when it activates, smart money doesn't just get nervous, they run. And right now, in December 2024, this signal isn't just flashing. It's screaming at levels we haven't seen since the moments before the 2008 collapse, before the dot-com crash, before every major market meltdown that destroyed fortunes and reshaped entire economies. The silver market is trying to tell us something urgent, something that could change everything you think you know about where we're headed financially. Because what most people don't realize is that silver isn't just a precious metal. It's a mirror that reflects the true health of the entire financial system. And right now, that mirror is showing us a reflection that should terrify anyone paying attention. My name is Alex, and for the past 15 years, I've been tracking precious metals markets, studying their patterns, their signals, their warnings. What I'm about to show you isn't speculation. It's not fear-mongering. It's documented historical pattern recognition that has predicted every major crash for the last 100 years. And the pattern is telling us we're standing at the edge of something catastrophic. Here's what makes this different from every other market warning you've heard. This isn't about economic theory or complex financial models that only Wall Street understands. This is about a simple, measurable signal that ordinary people can see and understand. A signal that has never been wrong, not once. And when you see what I'm about to show you, when you understand how this signal works and why it's activating right now, you'll realize we're not just approaching a market correction. We're approaching a complete reset of how money itself functions. The signal I'm talking about is called the silver ratio divergence. And before you think this is just another technical analysis buzzword, let me explain what this actually means and why it matters more than any economic indicator you've ever heard of. Throughout history, silver and gold have maintained a predictable relationship. For thousands of years, the ratio between silver and gold prices stayed within certain boundaries. When those boundaries break, when that relationship becomes distorted beyond historical norms, it signals that something fundamental is breaking in the monetary system itself. Right now, that ratio has reached levels that have only appeared 3 times in modern history. 1929, right before the Great Depression. 2000, right before the dot-com collapse. 2008, right before the global financial crisis. Each time, the signal appeared months before the crash. Each time, the few people who understood what they were seeing got out early and preserved their wealth. Each time, everyone else got blindsided by what seemed like a sudden collapse that nobody saw coming. But here's the critical detail that makes this moment different from those previous warnings. This time, the signal isn't just reaching those dangerous levels, it's exceeding them. The silver ratio divergence we're seeing right now is deeper, more extreme, and more sustained than anything in recorded history. We're not just approaching the danger zone, we've blown past it and entered completely uncharted territory. What does this mean practically? It means the disconnect between real value and perceived value has become so enormous that something has to give. And when it gives, it won't be gradual, it won't be manageable, it will be sudden, violent, and total. The kind of collapse that doesn't just hurt speculators and day traders, the kind that reshapes entire societies and destroys the savings of ordinary families who thought they were safe. Let me show you exactly how this works, because understanding the mechanism is the key to understanding why this signal has never failed. Silver has always been the monetary metal of the common people. While gold was hoarded by kings and central banks, silver was what ordinary citizens used for daily transactions. It was real money, backed by something tangible, something you could hold in your hand. When paper money replaced silver coins, when governments moved away from precious metal backing, silver became something else. It became a thermometer for monetary stability. Here's why that matters. When confidence in paper money is high, when people believe in the stability of the financial system, silver trades primarily as an industrial commodity. Its price reflects supply and demand for electronics, solar panels, medical devices. The ratio between silver and gold stays relatively stable because both metals are seen as relics, curiosities for collectors, and conspiracy theorists. But when confidence begins to crack, when people start to question whether paper promises can really be kept forever, silver transforms. It stops being just an industrial metal and becomes money again. Real money. The kind that can't be printed, can't be digitized, can't be created with a computer keystroke. And when that transformation happens, the ratio between silver and gold explodes. That's exactly what we're seeing right now. The silver-gold ratio has broken out of its historical range and entered panic territory. Not gradual concern, not mild uncertainty, panic. The kind of panic that happens when massive institutional investors, the smart money that moves markets, quietly begins preparing for the unthinkable. But here's what makes this signal so reliable and so terrifying. It's not just individual investors buying silver, it's entire nations. Central banks that have spent decades telling us that gold and silver are barbarous relics are now buying precious metals at rates not seen since the 1970s. Russia has been accumulating silver aggressively. China has been stockpiling both gold and silver through state-controlled entities. Even Western central banks that publicly dismiss precious metals are quietly diversifying their reserves. Why would they do this if everything was fine? Why would the same institutions that create paper money be hedging against their own currencies? Because they know something that most people don't want to hear. The current monetary system, built entirely on debt and promises, has reached its mathematical limits. You cannot print prosperity forever. You cannot borrow from the future indefinitely. And when the accounting finally comes due, when the promises can no longer be kept, precious metals become the only real money left standing. The silver ratio divergence is telling us that day is approaching faster than anyone wants to admit. Every time this signal has appeared in the past, it preceded a period when paper assets collapsed and real assets soared, not in years or decades, in months, sometimes in weeks. In 1929, the signal appeared in the spring. By October, the stock market had collapsed and the Great Depression had begun. In 2000, the signal flashed in early summer. By March 2001, the Nasdaq had lost 80% of its value. In 2008, the warning appeared in January. By September, Lehman Brothers had collapsed, and the global financial system was in free fall. Each time, the pattern was identical. The signal appeared. Smart money recognized it and began positioning for chaos. Everyone else dismissed it as noise, as fear-mongering, as the rantings of gold bugs and doomsday preppers. And each time, the smart money was vindicated while everyone else lost everything. The difference this time is the scale. Previous crashes were regional or sector-specific. The 1929 crash primarily affected the United States. The 2000 crash hit technology stocks. The 2008 crash focused on housing and banking. But the signal we're seeing now isn't regional or sectoral, it's global and systemic. Every major economy is running unsustainable deficits. Every major currency is being debased simultaneously. Every major financial institution is leveraged beyond historical precedent. When this system breaks, and the silver ratio is telling us it will break soon, there won't be a safe haven country to flee to. There won't be a stable currency to hide in. There won't be a functioning banking system to preserve wealth. The only things left standing will be real assets. Physical things. Tangible value. That's why the silver signal matters more than any other economic indicator you can find, because it's not measuring confidence in this policy or that market. It's measuring confidence in the entire concept of paper money itself. And right now, that confidence is evaporating at an accelerating pace. The numbers don't lie, even when governments try to massage them into acceptable narratives. Silver demand from industrial applications has remained relatively stable, growing modestly with technology adoption. But silver investment demand has exploded by over 400% in the past 18 months. That's not gradual portfolio diversification. That's panic buying from institutions that understand what's coming. The most disturbing part isn't just that the signal is flashing, it's how it's being ignored by mainstream financial media and government officials. Every previous time this warning appeared, there was at least some acknowledgement from serious analysts that something unusual was happening. There were whispered concerns in financial circles, quiet preparations by prudent investors, subtle shifts in institutional positioning. This time, the silence is deafening. The same experts who missed every previous crash are telling us that everything is fine, that the economy is strong, that inflation is transitory, that the unprecedented monetary expansion of the past decade has no consequences. They're either lying or they genuinely don't understand the forces they've unleashed. Neither possibility should give you comfort. But the silver market doesn't care about narratives or political spin. It responds to mathematical realities, to supply and demand fundamentals, to the inexorable logic of monetary physics. And the physics are telling us that we've reached a point where the gap between perception and reality has become unbridgeable. Here's the specific mechanism that makes this collapse inevitable. Over the past 15 years, central banks around the world have created more money than in all of previous human history combined. Trillions upon trillions of dollars, euros, yen, yuan, pounds, all conjured into existence with nothing backing them except promises and confidence. That money had to go somewhere. Initially, it inflated asset prices. Stocks, bonds, real estate, everything denominated in paper currency rose in value. But asset inflation isn't wealth creation, it's wealth redistribution. When you double the money supply, you don't double the real wealth in the economy. You just change who owns what proportion of the existing wealth. And eventually people start to notice that their paper money buys less real stuff than it used to. That's when they begin looking for alternatives. Gold has always been the traditional alternative, but gold has a problem in the modern world. It's been largely captured by central banks and large institutions. The gold market is dominated by paper derivatives, by contracts and promises rather than physical metal. You can manipulate paper gold prices through futures markets and financial engineering. It's much harder to manipulate physical silver. Silver is the monetary metal that governments forgot to control. While they were busy managing gold prices and currency markets, silver remained relatively free. And that freedom is now becoming a problem for the entire system, because silver is telling the truth about monetary conditions while everything else is telling lies. The silver ratio divergence isn't just a technical indicator, it's a truth detector. And the truth it's detecting is that the current monetary system has reached its breaking point. We're not approaching a recession or a market correction. We're approaching a monetary reset. The kind of reset that happens maybe once per century, where the entire foundation of how money works gets rebuilt from scratch. Previous resets happened gradually, over decades. The transition from gold standard to Bretton Woods took years. The shift from Bretton Woods to pure fiat currency happened slowly through the 1970s. But this reset will be different because the imbalances are so much larger and the interconnections are so much deeper. When confidence breaks this time, it will break globally and simultaneously. The silver signal is telling us exactly when that break will happen. Not the precise date, but the proximity. We're not talking about years or decades. We're talking about months, possibly weeks. The acceleration in silver accumulation by major players suggests they know something specific, something urgent, something that requires immediate preparation rather than gradual positioning. What happens next follows the same pattern we've seen before, but amplified by the scale of modern financial markets. First, there will be a crisis of confidence in a major currency or financial institution, something that seems contained, manageable, temporary. The authorities will assure everyone that it's under control, that the system is sound, that normal operations will resume shortly. But this time, the crisis won't stay contained because the system has no reserves left, no margin for error, no ability to absorb even minor shocks. Every major institution is leveraged to the maximum. Every government is running deficits that require constant refinancing. Every currency depends on confidence that can evaporate instantly. When that confidence breaks, when people start demanding real value instead of paper promises, the silver ratio will explode upward as industrial silver gets repriced as monetary silver. Not gradually, but suddenly. The same way bank runs happen, the same way currency crises unfold, the same way every financial panic in history has developed. The few people who recognize the signal early, who understand what it means and act accordingly, will preserve their wealth through the transition. Everyone else will discover that their paper assets, their digital accounts, their retirement funds were never really theirs to begin with. They were just entries in a computer system that could be changed or eliminated whenever the authorities decided it was necessary. This isn't prediction. This isn't speculation. This is pattern recognition based on historical precedent and current conditions that exactly match previous breaking points. The silver ratio divergence has never given a false signal. It has never failed to predict major monetary crises, and it's screaming right now at volumes that should terrify anyone who understands what they're looking at. The smart money isn't waiting for confirmation from financial media or government officials. They're not waiting for permission to protect themselves. They're acting on information that's available to anyone willing to look at the data objectively and understand what it means. The silver signal isn't hidden or secret. It's public information that most people simply don't know how to interpret. The time for denial is running out. Every day that passes, without acknowledging what the silver signal is telling us, brings us closer to the moment when preparation becomes impossible. Because once the crisis begins, once confidence breaks and the panic spreads, there won't be time to position yourself safely. Markets will freeze, premiums will explode, and physical assets will become impossible to acquire at any reasonable price. We've seen this movie before, but never at this scale. In previous monetary crises, people could flee to other currencies, other countries, other asset classes. But this time, the crisis is baked into the entire global system. Every major currency is being debased simultaneously. Every major economy is running unsustainable deficits. Every major financial institution is interconnected through derivatives and debt instruments that amplify rather than absorb shocks. The silver ratio divergence is measuring this interconnectedness, this systemic fragility that didn't exist in previous eras. When silver was money, when currencies were backed by precious metals, monetary crises were self-limiting. Countries that debased their currency too aggressively would face immediate consequences as their money lost value relative to gold and silver. The feedback was instant and corrective. Today's system has no such feedback mechanisms. Central banks can create unlimited amounts of currency without immediate consequences because everyone is doing it together. The dollar might be weak, but it's weak relative to what? The euro that's also being printed without restraint. The yen that's been debased for decades. The yuan that's backed by a command economy built on impossible debt levels. This is why the silver signal matters so much right now. It's not measuring one currency against another. It's measuring all paper currencies against real money. Against something that can't be printed, can't be digitized, can't be multiplied by government decree. And that measurement is telling us that paper money itself is approaching worthlessness on a global scale. The historical precedent is clear, but the scale is unprecedented. Previous monetary collapses affected regions or empires. Rome debased its currency and collapsed, but the world moved on with other monetary systems. Weimar Germany printed itself into hyperinflation, but other countries maintained stable currencies. Even the 1970s inflation crisis was primarily a dollar phenomenon that other nations could escape by diversifying their reserves. But this collapse will be different because there's nowhere to run. Every government has adopted the same failed policies of unlimited money printing and deficit spending. Every central bank has painted itself into the same corner of unsustainable monetary expansion. When the silver ratio explodes upward this time, it won't be signaling the collapse of one currency or one system. It will be signaling the end of the entire post-1971 monetary experiment. What makes this moment particularly dangerous is the speed at which modern markets can move. In 1929, news travelled by telegraph and telephone. Price discovery took hours or days. Margin calls were processed manually. There was time for second thoughts, for interventions, for coordinated responses. Today, algorithmic trading can execute millions of transactions per second. High-frequency trading can amplify price movements beyond anything human traders could imagine. When confidence breaks this time, the cascade will happen at electronic speed. The silver signal has spoken. History has provided the roadmap. The pattern has never failed, and it's not going to start now. We're standing at the precipice of a monetary reset that will redefine wealth, power, and survival for generations. The smart money has already moved. Central banks have already positioned themselves. The only question remaining is whether you'll recognize the warning before it's too late. This isn't about getting rich quick. This is about preserving what you've built before the system that created it disappears forever.